All right, we're here with Don Steinbrugge again, the founder and managing partner of Agecroft Partners, and we've got a brand new year, Don. It's been a crazy year, 2015, for hedge funds, and you make an interesting point about how hedge funds have to adapt to this changing environment. So let's go through some of your top 10 things that you think 2016 holds for hedge funds. We'll start with reduction of expected returns for a diversified hedge fund portfolio. What do you mean by that?
Well, what I mean by that is hedge funds get their returns from two sources. One is alpha or manager skill, picking undervalued securities, and the other is their market exposure. You know, hedge funds have different market exposure depending on how much they hedge. And since 2009, those with the most market exposure have benefited because the equity and fixed income markets have gone straight up. Going forward, most investors are not expecting a lot of return from the markets because valuations of both the bond and equity markets are close to all-time highs. Fed's going to raise interest rates. So in 2009, they expected about a 15% return from their hedge fund portfolio. In 2014, it had gone down to 10%. Right now, most hedge fund investors are looking at a 7 to 8% return on a diversified hedge fund portfolio, which still looks pretty good relative to the fixed income markets.
Interesting. Okay. Greater demand for hedge fund strategies with low correlations to long-only benchmarks.
So what's happened is that the reduction in returns is going to cause a dramatic shift in the demand for various hedge fund strategies. Those hedge fund strategies with a lot of market exposure got most of the assets over the past 5 years, and you're going to begin to see a lot of investors take money off the table and invest in hedge fund strategies that are not correlated with the equity or fixed income market. Strategies like relative value fixed income, equity market neutral, which we spoke about on your show before, CTAs, global macro, volatility, you know, any type of strategy that is not dependent on the market, that can protect during a market sell-off, you're going to see money flowing into in 2016.
Okay. Increased hedge fund marketing activity outside of the U.S.
Well, what happened over the past few years is the Eurozone has put in legislation requiring hedge fund managers to register in each individual country throughout the Eurozone in order to sell there. Before that, hedge fund managers could just go wherever they wanted, and you know, roughly 30% of the assets that they raised came out of Europe. When this legislation was passed, you began to see a significant number of hedge funds stop marketing outside the U.S. What did that do? It made the U.S. market much more competitive because the 30% of the time they were outside the U.S. are now focusing on the U.S. Plus, the U.S. Investors represent about 60% of assets flown into hedge funds. Hedge funds all over the world are focused on the U.S. U.S. marketplace is very competitive. I think you're going to see a reverse of that trend. I think you're going to begin to see U.S. hedge fund managers going back to Europe. Much easier to raise assets, not as difficult to register in those countries as they thought it would be.
Interesting. Okay. Hedge fund industry assets to reach an all-time high in 2016.
Yeah, that may be a surprise if you read most newspapers, because most news about the hedge fund industry is very negative. They talk about a lot of name brand hedge funds have closed down recently. You know, their performance is in 2016 was close to flat. But the reality is there's not a lot of alternatives for investors to invest in. A lot of people are worried about the fixed income marketplace. You know, the aggregate bond index right now is yielding about 3%. If interest rates go up, it could post negative returns. You know, equity markets are close to their all-time highs. So you're going to see some investors taking money out of fixed income, investing it in hedge funds. You're going to see some people taking money out of the equity markets, putting in hedge funds. You know, now is when hedge funds should do well. When the markets are doing great, you can get market exposure by buying an index fund at a very low fee. When markets aren't expected to do well, you want strategies that are hedged, that are not correlated to the markets.
That's when they earn their money, I guess.
This is when they should earn their money. Yes. That's correct.
Okay, smaller managers will outperform. That's interesting.
So if markets are going up, large managers can do very well just by having market exposure. But if the market isn't going up and most of your return has to come from security selection, smaller managers have an advantage. And that's because if you get too big, it's very hard to add value through security selection, because investing in smaller illiquid securities, you can't put a lot of money in them. They become less and less a percent of your portfolio, so they get diluted over a very, very large asset base. So smaller managers focusing on niches should have a distinct return advantage over large managers that have gotten too big.
Okay. Pension funds reducing the average size of managers they allocate to, so you don't have to have billions and billions to get the attention of a pension fund?
Yeah, it's interesting. Pension funds are going through an evolution of how they invest in hedge funds. They first invested in fund of funds, which were basically a fund that invested in a diversified portfolio of hedge funds. Then they hired an institutional investment consultant, and they tended to buy the largest hedge funds with the strongest brands. They were more concerned about headline risk than generating the highest return possible through their hedge fund portfolio. As they get more experience, they build out their internal staff, and they begin to focus on hedge funds that they think are going to generate the highest returns, and that tends to be small to mid-sized managers. So it used to be you had to have $5 billion in AUM to get money from a pension fund. Today it's about $750 million, and that dollar amount is going down over time.
Okay, high quality marketing essential for asset growth.
The market's changed dramatically. Early last decade, if you had good numbers and you put them in a database, investors came. Matter of fact, you could be cocky, you could not give them a lot of information, you could throw them out, if you didn't like them, and the whole market has changed. If you have good numbers today, if you're in the top 10% highest returning hedge fund managers, you're in an exclusive group of 1,500 managers. So to get money in the hedge fund industry today, you not only have to have a great product with great performance that ranks well across each evaluation factor investors use, but you have to go out and meet with people, because if you don't, assets just aren't flowing.
Interesting. Okay, continued pressure on fees. So is there some negotiation room on fees that we haven't seen in the past?
There's a lot of pressure on fees. Now that there are 15,000 hedge funds out there, institutional investors are aggressively negotiating fees on large mandates that they give. They're often getting at least a 25% discount on standard fees. Smaller hedge funds are having a very difficult time raising money, and they're basically getting squeezed from two different aspects, from the revenue side and from the fee side. They're often having to offer what is called founder share, which is a 25 to 50% discount off standard fees. You're also seeing a number of hedge fund managers turn to 40 Act funds or mutual funds, which have significantly lower fees than standard hedge funds. So a lot of pressure on fees. It's not going to go away. You're going to see hedge fund fees come down over time.
Wow, whole new world. Okay, more hedge funds shutting down.
Yeah, I think in 2016 you're going to see an all-time high number of hedge funds shutting down, and there's a number of reasons. First of all, the number of hedge funds are at all-time high. So if you have a consistent number or percent of hedge funds shutting down each year, by definition you should have all-time record this year. But in addition to that, with 15,000 hedge funds, the average quality of hedge funds is a lot lower today than it used to be. There are a lot of lower quality hedge funds out there. Their close rate's going to be a lot higher than what you've seen historically. In addition to that, I'm expecting a lot of volatility in the marketplace, and volatility increases the number of hedge funds shutting down. Reason being, if you don't have a lot of volatility, performance tends to be pretty close across hedge funds versus various strategies. Volatility increases the dispersion of returns between good and bad managers. And when you have a big dispersion of return, ones with bad performance gets fired, and that money is reinvested in better performing managers. And then finally, what I just mentioned, smaller managers are getting squeezed on both sides. Okay. Their fees that they're able to charge are a lot less than what they used to be. In addition, they're having to look more institutional. They're having to hire more people, hire more systems. And as a result of that, you're going to unfortunately see a number of these small managers just not raise assets and go out of business.
It's tough to make money in that kind of environment. Okay, finally, number 10, blurring the lines between hedge funds and private equity funds. We've kind of been seeing a little bit of that over the past few years, it seems like.
Yeah, you really have. Back in 2008, really the difference between some private equity funds and some hedge funds was really the structure of the fund. How long you had to commit your money, how often you could get your money out. There were private equity funds and hedge funds investing in the same illiquid fixed income strategies, and back in 2008, those hedge funds got in big trouble because they were given monthly liquidity. The securities they're investing in were not liquid, and when people wanted their money, they just couldn't give it. So they had to suspend redemptions, put up gates. Today, because of where interest rates are, you're seeing a lot of interest in less liquid strategies that have higher yields. And so these hedge funds are beginning to put in structures very similar to private equity. So there's a blurring of the lines between private equity and hedge funds. You're going to see a lot more money going into things like private loans, reinsurance, and other strategies that are less liquid, but they're going to have longer lockups and less liquidity provisions than they did historically.
Okay, interesting. It's already been an interesting start to the year for those in the financial industry. It looks like it's going to get even more so. Thank you so much, Don, for sharing these thoughts about the hedge funds in 2016.
It's my pleasure.